Welcome to the Insightful Investor Podcast, a weekly series that seeks to share industry, investment, and market insights. Learn more about our show at insightfulinvestor.org. Today, I'm joined by Tony Davidow, Senior Alternatives Investment Strategist at Franklin Templeton, which manages $1.6 trillion as of the end of June. So it's a lot of money, Tony. Tony is widely recognized for his expertise in portfolio construction and alternative investments, in particular, spanning private markets and hedge funds, and is dedicated to advancing investor education through his work in white papers, books, and podcasts. On this episode, we'll explore Tony's diverse vantage points, his framework for building optimal portfolios, and how education can reshape access and comfort with alternative assets. We'll dive deep into the differences between institutional and private wealth investing, the evolving landscape of alternatives, and practical advice for today's investors. Tony, thank you so much for joining us.
Alex, thanks so much for having me.
Well, let's kick it off with your background. Your investing career spans over 4 decades, starting in family offices and evolving through several institutional roles. Would you share what initially drew you to this field and how those early experiences shaped your investment philosophy?
Yeah, so when you say that, I just feel old. I've clearly been doing this for a long time. But as you know, I started my career working for a family office, which was really very fortunate because I had the opportunity to have a front row seat for large families, how they think about allocating capital, and specifically the role that private equity and private real estate can play in fulfilling outcomes for decades and decades. So it really was just a valuable experience and allowed me to kind of look at the world from a much different lens than I think the traditional sort of path that an advisor might go on. I was fortunate as well to work at a lot of great organizations. Most notably, I spent nearly 15 years at Morgan Stanley. And as you know, I worked there initially to build and manage our institutional consulting business. So I work with large endowments and foundation and pension plans. And, very early on, recognize the value of having these versatile tools that we'll delve into a little bit here today. But recognize at the same time that even though they were large and sophisticated institutions, they didn't always understand. So I try to approach them more from a consultative process and really talk to them about the merits of the strategies first before adding them to the portfolios. My next step along the way at Morgan Stanley, I think, was influential as well, because I then later moved into a business called Greystone, which at the time of the acquisition was a multifamily office boutique with an expertise in alternatives. And what we did is we scaled that platform, and it allows us to bring open architecture to Morgan Stanley's private wealth management business. While I was there, I had the opportunity to work with a lot of founders, a lot of our banking clients. And I think what I really got out of that experience was a lot of those individuals were senior executives at startup companies. And I really saw the journey from that private enterprise to going public, because at that point in time, that was really the only path available to them, or was a path that at least allowed them to monetize their business. So I saw firsthand the value of running a private enterprise without somebody looking over your shoulder, thinking long run, executing your strategy, getting capital and investing it wisely in your business. So I think that was definitely very influential. And not surprisingly, a lot of those ultra high net worth families, especially when they sold their companies, were very comfortable having substantial allocations to private markets because they recognize the value and the freedom it affords. And maybe just my last role, and I'll just kind of stop there. My last role at Morgan was really providing education, which is, I know, where you wanted to take our discussion, because at that point in time, what we recognized across our retail channel, as much as they wanted to have access to a lot of the same tools and investments, they just weren't available at that point in time. So a lot of the work that I did, which is something you and I were talking about earlier, is I shared the experiences of how family offices and institutions allocate capital and tried to help translate how do we bring those best practices downstream, make them more applicable for the advisor and the wealth channel. And I'd argue today, we're at a substantially different point of time because now we have an abundance of products available by world-class managers. And now the challenge is, how do we help advisors have these better informed decisions? So thank you for having me. And I know that's where you want to take the discussion here today.
That's perfect. How would you say your vantage points across the different types of investors you described, family offices, institutions, and now you have a heavy focus on education driven roles? How would you say those perspectives have shaped your views on efficient portfolio construction?
Yeah, they really have, and I think from the very beginning, what I got out of thinking about this is we shouldn't think of them as a product, right? They're really part of an overall solution. So we're not saying private equity is better than public equity. We're saying what's the right combination of public and private. And I think with certainly with families and large family offices and institutions, their time horizon is much longer than the average investor, but they certainly saw the value of allocating capital over the long run and being handsomely rewarded for the illiquidity premium. Not to get too much into the weeds, but I know we'll get into it. The excess return that you get for allocating capital to private markets over the long run. They had the patience to do so, and they were handsomely rewarded for allocating significant pools of their money to private markets. And I think now, as these strategies are starting to come to the wealth channel, we recognize the intellectual argument, which is a relatively easy one, which is I want to capture that excess return. The more challenging and nuanced thing is how do we then bring that to an individual family who may be concerned about illiquidity, locking up capital and not having access to it, not understand the nature of the underlying investments, which sometimes make it feel riskier, or understanding the new structures coming to the market because they're not mutual funds and they're certainly not like the first generation of products. So I think there's a huge educational gap that we're trying to help people to smooth that ride a little bit.
And how would you say over your career, your approach to educating others about investing has evolved? And why has that become such an important part of your work?
I think it's evolved, but I'd also argue that the world has evolved. So if I go back to my early days, alternatives broadly and private markets specifically were really only available to institutions and family offices. They might have been something that advisors wanted to use with their practices, but either because of the high minimums or they weren't available on the various platforms, it was nearly impossible for the wealth channel to access the best of the best private equity managers. So it was something only available to large families, institutions, and of course they use these tools in a very significant way. We can certainly talk about the endowment model and the work that David Swenson did, but not surprisingly, there they had the wherewithal. They had an extended time frame to allocate capital. They often thought of allocating capital for perpetuity. We all know that the L endowment, through much of Swenson's career, had a 70 to 80% allocation to alternatives and a 50% illiquidity bucket. Well, that's not the same allocation that we would suggest for individual clients because they don't have that freedom to allocate for perpetuity. They have expenses, but there are certain lessons that we can learn from that. So, yes, as much as we look at institutions and family offices and we try to learn from their best practices, we also need to be sensitive to the fact that individual investors have different timeframes, different tolerance for illiquidity, different levels of understanding. And again, a lack of understanding also often assumes that there's a little bit more risk, and we can kind of tackle that in a little bit here. So I think we try to certainly leverage the lessons learned from institutions and family offices, but we don't want to blindly follow what they've done because there are pretty big differences between individuals and institutions.
So before we dive in, I want to frame our discussion for listeners. There's often a wide gap between how the most sophisticated investors, like major institutions and family offices, build their portfolios and the way most private investors approach investing. Today's conversation is about uncovering what works best at the highest level, understanding the real world challenges, and some of them you just described, that prevent many from adopting those practices, and exploring what can be done to bridge that gap. Tony, I know you've devoted your career to advancing this mission, just as I have, as we talked about earlier, through podcasts, books, insightful content, and collaborating with leading voices in our industry. So let's dive into some more specifics. In an ideal world with no practical constraints, what does the most sophisticated investment framework look like, and why would you say top tier investors have gravitated towards this approach?
Yeah, and clearly it varies, and it varies in a number of different ways. It varies based on the client's ability to take on risk and their ability to allocate capital for the long run, but in kind of an unconstrained sort of world. And if I take a step back and I look at where the wealth channel has roughly been a 5 to 6% allocation to alternatives for the last 2 decades. The composition of that has changed a little bit over time. It used to be more hedge fund oriented. Now it's more private market oriented, but it's still a relatively small piece of the pie. And if we imagine that institutions are 40 to 50%, some of the larger ones are higher. Again, I mentioned, the Harvards and the Yales, that might be 50, 60, 70% allocation to alternatives. It's somewhere in between. If you just kind of the math on it and you start to illustrate the impact that it has in client portfolios, you can certainly imagine that a 15, 20, 25% allocation to alternatives starts to change the overall composition. It changes the risk, the return, the correlation, changes the ability to generate income in the portfolios. It doesn't mean that everyone gets there in the same path. And it doesn't mean that within that 15, 20, 25% bucket, that all look the same. And Alex, you and I were talking about the content that we produce. So a lot of my time has been focused on helping advisors through the portfolio construction process. I've written a series of white papers, all under the large banner, Building Better Portfolios, which I use case studies to illustrate the impact of that. And I use case studies because I think it makes it feel a little bit more real and relatable when you go back to your practice and you start to think about this. And I think what's so exciting today is I don't use a single solution where, if you and I go back in our careers a little bit, the first generation of products we had access to were fund of funds. We didn't have the luxury of being very discreet to say, how much do I want to have in private equity versus private credit versus private real estate? Now, with these new products that are available to us, we can actually have a diversified private market exposure, or if we want to be a little bit broader, diversified alternative exposure. And I think that's a really good thing, because then we can start to hone in on what role specifically do these types of investments play. So I could have two clients that both have a 15 or 20% allocation, but the underlying composition of those strategies might be very different. A younger investor who's more growth oriented and is more in the accumulation phase might have a higher private equity allocation. And a older investor, somebody of my generation who might be closer to retirement, may have a higher allocation of private credit or private real estate because you need to generate more income. So the beauty of where we are today is we're now developing and introducing robust toolboxes for advisors, so you can think about it the same way that you've historically thought about allocating capital across your traditional investments, which is, what specific role do these investments play? And how do I combine them in the optimal fashion to increase the likelihood of achieving my goals over the long run? So I'd argue we've never really been at a better point in time to be having this discussion.
We talked about institutions typically having a lot more in alternatives than individual investors that may have a lot less. And one of the gaps was the availability of those strategies. Are there other constraints that you feel tend to drive the differences between the institutional and family office portfolios and the private portfolios?
Yeah, I think it's a comfort issue. So if I go back to the comment about if we're, as an industry, 5%, I think a lot of advisors understand the intellectual argument. The intellectual argument is pretty easy, right? We all know what the data tells us. I think sometimes it's the behavioral elements, right? We all understand the difficulty of giving up control. And I think illiquidity is one of the largest issues. It's an issue that we certainly speak about and write about quite a bit. One of my most popular papers is The Cost of Being Too Liquid. And I wrote it in part because it was a comment that I was hearing a lot from advisors in the field, which is, my client and I am also concerned about tying up capital for an extended period of time, whether that's 7 to 10 years. It just feels uncomfortable. I understand I'm going to be rewarded, but it feels uncomfortable. So what I tried to do in that paper, and what I try to do when I'm in market speaking to advisors, is just recognize illiquidity is a feature. And for whatever reason, we've conditioned investors to think you need to be 100% liquid. I don't think that's the right answer. And Alex, you know better than I do, when things get volatile, you don't want clients having that temptation to head for the exits at the wrong time for the wrong reason. So wouldn't it be great if we could actually take a portion of their capital, and let's call it an illiquidity bucket, and we develop an illiquidity bucket during our normal discovery process, right in the beginning of the relationship. We establish how much of your capital Are you comfortable tying up for 7 to 10 years? I'm going to call that my illiquidity bucket. The next time we get a shock to the market, and we know there'll be another time when that client says, I'm uncomfortable, so that's great. Let us deal with that with your traditional investments. We can take a little risk off the table with our traditional investments. We can be maybe a little bit more tactical with my traditional investments. But at least for this portion of your money, we're actually going to teach you to be a true long-term investor. We're going to put that aside. We're going to treat it differently. And we're going to think about that as a long-term allocation of capital. Or as family offices think about it, that's our patient capital. I actually think that's a good thing. So the negative that we often hear from advisors and investors really is just a feature that we should be leaning into and saying, I think for a portion of my capital, I should be accepting that illiquidity risk. I should be allocating the capital because I know in the long run I'm going to be handsomely rewarded for it. So again, there's a lot of challenges out there from just understanding the nature of the underlying investments, understanding the fact that there's a familiarity sort of bias where individual investors will say, I look at my account statement and I recognize Apple and Google and Microsoft, and I look at these private equity investments and I don't understand what they are. I've never heard of them before. I sometimes try to personalize that a little bit and give them real stories and remind them that all of those names that you're familiar with started as private enterprises. They were all private companies that had an idea. They needed capital to get started. They potentially needed some adult supervision, some more senior leadership to help mature the company. And many of those went the path of going public via an IPO. So the more we get them comfortable with what the underlying investments are, how they work, understanding the long-term nature of it, I think the more comfortable they get. I don't think we as an industry go from 5% to 20% in one fell swoop. I think it's going to be a gradual thing. And I think it will be a gradual thing as investors and advisors have better experiences. You get more comfortable with a 10% allocation. Then you get more comfortable with 15% allocation. And then you get more comfortable with larger and larger allocations. When I go back to my days working in the private wealth division of Morgan Stanley, a lot of our big banking clients had 50% allocation to alternatives. They saw the value firsthand as they were bringing their company through that private to public cycle. And they were comfortable with allocating because they know they'd be handsomely rewarded. So I think the more that we can get individual investors comfortable with that experience, will gradually increase the allocation over time. But I don't think it's one fell swoop, and I don't think it's one easy fix.
The illiquidity premium, I think, is an interesting conversation because giving up liquidity it can be uncomfortable, especially when you're tied up for a long period of time. But that's one of the reasons you get rewarded for that. So you can actually turn that argument on its head and say the reason you're uncomfortable is the same reason why you benefit from it long term, because others have the same feelings.
That's why I don't shy away from it. I try to address it up front because I think sometimes if we're not upfront and transparent with investors about these things, their natural inclination is, well, why aren't you talking to me about the fact? I mean, the worst experience would be you get them into this great fund and then they wake up tomorrow and they say, I want out. So it doesn't work that way. So I always try to get in front of it. But to your point, it's just a feature. And in fact, I'd argue it's actually instilling the discipline that we really want investors to have. Alex, I know you probably experience it, every day. You sit down with a client and you ask them about their risk tolerance and their time horizon. 90% of clients say my time horizon is long term and I can take on a lot of risk until there's a bump in the road. And then all of a sudden it's like, well, I mean, that's a quarter, right? No, long term is long term and you're handsomely rewarded if you can do it. But let's determine in advance how much of your capital can you comfortably allocate for the long term. And if that's 10, 15%, and you have a good experience, I think you'd be comfortable increasing that afterwards.
Yeah, it's very similar to having the conversation of, let's say you wanted to start your own business. You're not going to look at the price every day and then after a quarter and say, oh, that was a bad period. I need to sell that business. I got to go buy another business. When you're investing, it's a very similar thing.
And I think that's a great analogy too, because I think the more you can personalize it so they start to think about, oh, well, yeah, I understand why it is that I'm actually giving the manager more time. These are young companies. They need to mature. Maybe they're going to make some acquisitions. The other thing that I don't think we talk enough about as an industry, and I certainly try to weave it into my discussions, mostly with advisors, but I think it's probably sophisticated investors will pick up on it as well, is the value of the private equity firm. Not only it's the capital that they provide, i.e. money, but it's the human capital. And, I use the example in my book. I talk about Google. When I was at Morgan, I had the opportunity to work with a lot of the Google executives. And I think we need to remind people of the journey that they went on. We had two very young PhD students at Stanford who came up with the idea of Google. And in fact, when they started, it was PageRank. It wasn't Google at the time, but they had this idea, which is a lot of how these great ideas start. They had an idea. They didn't really know where it was going to go. They got some early funding. Jeff Bezos, by the way, was an early investor in Google. They got some early funding and they had some ideas. And then all of a sudden they started to get some traction with their business, and they recognized, if we want to go public, we actually need to bring in somebody who's actually managed a public enterprise and understands all of the regulatory requirements and all of that. So they hired Eric Schmidt, who is the former CEO of Novellus, and all of a sudden now they're a real company. Now they were able to prepare for going public. And we all know what happened after they went public. They made a series of acquisitions, and now they're a, multi-trillion-dollar company. But when they started, it was just an idea. And I'm not sure they really knew exactly where that business would go. That's the path that a lot of young private companies go through. And it would be a mistake for them to go public at that point in time because they hadn't really quite figured out their business model. But along the way, it's not only the money that they needed, but they needed somebody like Eric Schmidt to navigate them to the next level. And I think sometimes that gets lost in the shuffle because the private equity companies are often giving them access to a new CEO, a new CFO, making introductions within their network, helping them make acquisitions. That human capital is really one way that they can unlock value over the long run. And it's part of the reason that they generate that illiquidity premium.
So going back to our conversation of, you have this gap between the more sophisticated investors and the private investors, and one having more alternatives, one having less alternatives. How much of that gap can be closed with investor education as well as the democratization of access to alternative investments?
And I think that's kind of a great point because it's clearly both, right? It's a combination of better understanding of what are some of the trade-offs along the way. I think to the first part of that question, I would just clarify that I don't believe that every client should have a 20% allocation, if that's the magical number and all of that, because to your point, I do think there are a lot of constraints, depending on where a family is and considering what their cash flow needs are. If they don't have the time commitment and the time horizon, it wouldn't make sense for them to have big allocations. And maybe it wouldn't make sense for them to have any allocations if they're liquidity constrained, if they've got significant cash flow needs over the short run. That would be a mistake to allocate capital over the long run and then only be begging to get it back, a couple of years down the road. So I think that's an important point to make. So as much as an industry, we may say that's directionally where we should go, some clients will be lower or none, and some are going to be substantially higher than that. And then to your comment about the democratization, which I think is a very exciting sort of time. I know some people cringe with the term democratization, and we're not suggesting that you invest exactly like a Harvard and Yale. But to me, what democratization means is now all of a sudden we have access to investments that most of us didn't have access to in the old days, right? So the first generation of private market funds were only available to qualified purchasers, 5 million or more in investable assets. So most advisors book a business, that means a portion of their practice, not the whole practice. But now with these evergreen funds, most of those are available to accredited investor or below with very low minimums between 2,500 and 25,000. So now I can actually scale my alternatives across my whole practice. And maybe more importantly, I can start to think about diversified exposure, which again, I think is the way that we should think about this. I don't know that we want to make a single solution. If we have the wherewithal, I'd much rather have a diversified solution. I'd much rather have some private equity, some private credit, and some private real estate. And now with those lower minimums, I can do that. So I think that definitely is fueling the growth that we see in the marketplace. And I'll just add to that, the other thing that makes this so exciting is we're now getting access to world-class managers. If we had a great structure, but we had second tier managers, we wouldn't have the same experience. But now that we're having access to institutional quality managers where they're making the same investment decisions they might be making for Harvard or Yale, you're getting that in your personal portfolio. That's a home run. That's a win-win all around. And that's a much different point in time than where we were 5 years ago or 10 years ago.
So education is part of it, but what would you say are some persistent differences in psychology between institutional investors and the private wealth channel?
Yeah, and Alex, you know better than me. I do think that psychological thing, the behavioral element, is a big part of it. You know, things that we don't understand feel riskier. So if clients aren't comfortable with how these strategies work, they feel riskier than they should be. Look at the data, it will tell a different story, but they feel risky. Time horizon, right? Time horizon and liquidity is somewhat related, but do we have a significant time horizon? Can I allocate capital for 10 years? If not, that's going to be a little bit of an impediment. Do we understand the structure? And it's complicated. They're not mutual funds. Evergreen funds are not mutual funds. There are constraints in how we get out. The paperwork's a little bit more complicated. You experience this a lot more than I do, but that's what I hear from advisors, the operational burden. It's a little bit more challenging. So clearly there are challenges out there. I think if you look at research from Cerulli and others, it kind of points to the same sort of challenges. We need to understand how the strategy works. We need better help with, processing the paperwork and just getting the account set up and all of that. We need to make sure that our clients understand, what's going on and that these are long-term investments in nature. I think all of the studies are really saying the same thing, which is we need to educate. An informed investor is going to have a much better experience than somebody who sold a product that doesn't understand these things until afterwards. But with all that said and done, I still think there's such a compelling reason to look at these investments because of the attributes that they provide. Opportunity for higher returns, the opportunities for higher income, the opportunity to have diversification when it matters the most, especially with market volatility. And something we don't talk a lot about is the ability to hedge the impact of inflation. Those four levers are really what we're always thinking about when we build client portfolios. We actually get those in very discrete ways with our allocation to alternatives.
And you touched on this earlier, but it's an education process it's a lifetime of learning. And the point is to start that process. And in many ways, it becomes self-reinforcing because you start it and you dip your toe in, you learn a little bit, you learn a little bit more with time, you learn through good periods, you learn through bad periods. And maybe you go from 5% to 10% in a few years, and then you gradually increase over time as you learn more. But it's not about having an education session, getting it, and then jumping, all of a sudden.
Yeah, Alex, you and I are 100% aligned on this, and you and I are both lifelong learners. We both enjoy learning. We've invested in ourselves. We're involved in organizations that continue to challenge us to think about how to serve the needs of clients. And I think that's a really important attribute, I think, in this environment. I do think that there's some people who are resistant to change and, kind of shy away from things that are hard. But I think for you and me, and I suspect many of your listeners, we embrace it. That's what makes this industry so exciting. It's not a one and done. Exactly to your point, it's not a one and done. It's something that continuously evolves. The reason at my age and my, career vantage point, I continue to do what I do is I love it. I love it because it's constantly changing. It provides both challenges and opportunities. The landscape is changing. The menu of options available to you is changing. The market environment, some of the geopolitical things happening outside of our borders provide challenges and opportunities. So to me, it's something we will continue to evolve, continue to engage with. And to your point about there's not just one thing. So we didn't talk about it, but I think you and I were talking about it a little bit before we got started. Franklin Templeton hired me originally to develop all of our alternative education. And I think what they recognized about halfway through my assignment was this isn't a one and done. This isn't putting a whole bunch of training modules on a shelf and expecting everyone to be better off because of it. We recognize that's a start, but we needed to have that constant sort of drip. So things like white papers and blogs and podcasts like this. And I happen to write a book because I like writing. And I really felt there was a need for kind of a more comprehensive story out there. But all of those things are tools to help advisors wherever they are in their journey. And you and I were talking about it earlier. Not everyone's on the same point in time, and we have to figure out how do we communicate with them. Folks like you and I like reading white papers and maybe reading a book while we're on an airplane. Others like to consume podcasts and blogs. So we want to create things that are digestible for however and wherever an advisor wants to consume information on their journey. The other element of that I'm hearing more and more of, and I suspect you are as well, is investors want to understand. And I was surprised when I launched my book that I had a lot of advisors, reach out to me and say, would you do a client event? Because you, in your book, you're actually reinforcing a lot of the things that I've been telling them for years. So I don't think we can lose sight of that second order discussion. Advisors, by and large, understand the need for private markets. It's something that we've been asking for decades. We now have access to it. But the discussion with the client can sometimes be challenging because they're not in this business like you and I are every day, or your listeners. So the more that we can help simplify, give them digestible sort of things to think about, the better it is for us in the long run. So I'd argue it's not only the education of the advisor, but it's how do we educate the underlying investor so they know what they are getting into.
Obviously, education has been a big part of your career. What are the most common misconceptions investors have about risk? And how do you help bridge the knowledge gap regarding alternatives?
I think I try to simplify things as much as possible. I think that you're 100% right. There's a lot of myths out there, misconceptions. Sometimes it comes from a lack of knowledge. Sometimes it comes from misinformation. There are people out there, and I see it every day, who are spreading things that aren't true, who are saying that they're riskier than they should be. I try to simplify it as much as I can, and I use a lot of case studies. And look, Alex, you and I are storytellers, right? Anyone at our stage of the career, you've recognized that you need to have stories to kind of tell that can be translated back into an advisor understanding this in a more relatable fashion. So when I think about it, I try to use case studies to talk about individual securities. I use the Google example. I talk about the size of the universe. So people, are concerned about, with so much money going into private markets, are we concerned that the illiquidity premium goes away? And I said, well, I would if it was a static, right? But we have to recognize kind of the market environment, and we need to be armed with the information. The public markets are shrinking. So the public markets today are half the size they were 2 decades ago. There were 8,000 companies 2 decades ago. There's about 4,200, 4,300 companies today. The private markets are growing. There are roughly 20,000 companies in the US alone with 100 million more in revenue. That's a growing pie. That's a growing opportunity set. By the way, there's 100,000 globally. So there's a growing opportunity set. So we need to think of what those challenges are, what's the pushback, and then be armed with the information. The reality is the private markets are a growing and richer opportunity set, and they represent a lot of great companies with great ideas. I'll give you one example I often use with advisors, and I think it would work with individual investors as well, which is we often think it's the household names that are the companies that we want to have in our portfolio because they're safe and they're secure and all of that. And we all often feel uncomfortable. And to your point about risk and misconceptions, it feels risky if I don't know the name of the underlying companies. Well, I'll give you an example of an underlying company that most individual investors are familiar with, SpaceX. SpaceX is a private company, and don't hold me to the number, but I think a $50 billion valuation or something of that magnitude. Do you think Elon Musk wants to bring another company public and go through the public scrutiny that goes with somebody looking over your shoulder quarter after quarter? And so my guess is he's going to actually keep SpaceX as a private enterprise for as long as he can. And there are other private companies that have decided to go down the same path. There are public companies that have actually gone private who will stay private. So to me, private and public are just different structures of owning pieces of a company. I think that private market universe will continue to grow, and I think the public market universe will continue to shrink. So to me, it's just a richer and deeper opportunity set.
The big difference between the two, obviously, is liquidity. And it seems that many investors overemphasize daily liquidity, even when it may not be necessary. And I guess part of that is just it's not that you need 100% of your portfolio to be liquid daily, but it's the opportunity to change your mind should you so choose. How should individual investors rethink liquidity needs as they move into alternative strategies?
Yeah, I think it's an opportunity for advisors to, again, to kind of lean into it and say, how much liquidity do you really need? You're right that everyone's going to say they're a long-term investor, and then there's a bump in the road, and they want to head to the exits with all of their money. That's not a prudent thing to do. I'm sure you're cautioning clients against doing that all the time. So, what if during our discovery process we just carve out a portion of that? And we're going to call that our illiquidity bucket. We're going to treat that pool of capital completely differently. I think that would actually be a good thing, and I think that would go a long way to teaching investors to be truly patient capital allocators. And then with the other pool of capital, again, if they feel risk in the market or they're uncomfortable with things, you could be more tactical with your traditional allocation. And again, I think that makes a lot of sense. And it provides a little more comfort for the individual investor because they don't need to be 100% liquid. They just need to have access to money in case they need it. But most people don't need access to 100% of their pool of capital. And in fact, if they did, they'd probably make the wrong decision at the wrong time. I just go back to all these Dalbar studies that you and I have looked at for decades and decades. And it always shows that the client experience is dramatically lesser than being in the market. Why? Because they chase where the returns were. They get out of things when they should be staying in them. And by the time they get back in, a lot of that run up has already occurred. So if we could instill a portion of that disciplined patient capital in their portfolio, I think that'd be a really good thing. So to me, I wouldn't shy away from it. I'd lean into it and say, it's just a feature. It happens to be a feature that will reward us generously if we're prudent and we do it appropriately. But I think it's something we should address head on.
So let's dig into alternatives a little bit. So when you're building a diversified portfolio with alternatives, how do you think about this concept of a separation of alpha and beta? And what I mean by that is distinguishing between the drivers of returns. Part of it is the market and what the market provides, and part of it is generated by the skill of the manager. So, how should investors think about this within alternative investments?
I'm sure you've seen the data on this, and again, it's something that I think certainly gets advisors' attention. I'm not sure for the individual investor will appreciate as much, but we all know the difference, the dispersion of return between the top and the bottom. Global equity fund is a couple hundred basis points. I wouldn't spend a lot of time and energy on it. Picking the fund isn't necessarily going to be your winning solution, and it's certainly not how you add the most value to your client. But the dispersion of return between the top and the bottom private equity manager could be 3,000 basis points, 4,000 basis points, depending on the time period that you look at it. So to me, there's a big difference, and that's where my alpha is. It's the alpha not only that the manager generates, but it's your alpha. Your ability to find those managers who are at the top is how you add a lot of value to your client. Versus with my traditional investments, I'm going to get a market return. Nothing wrong with a market return, by the way. I just don't want to pay a lot to get a market return. I don't want to pay alpha prices for beta results. If I'm not paying a lot of money and I'm getting a pretty consistent experience, then my asset allocation decision is much more important. But I'd argue when we look at the private markets, there's two levels of alpha. It's the alpha that those managers provide, and it's the alpha that you as an advisor can provide by allocating appropriately. And one of the things that is a little bit different than the way that we typically would look at traditional investments, we all know if we look at traditional investments and we look at the SPIVA persistence scorecard, the top manager often becomes the bottom manager. If we haven't looked at the data, we know it by experience. You do all this due diligence, you select the best manager, they have this really attractive dot plot on a piece of paper, and as soon as you select them, they become the bottom. What we find with private markets, and it's somewhat intuitive, is the top often stays the top. And the reason is the best managers are the ones who gets the best access and the best deals. So we do see more persistence of those top managers over the long run. So to me, that's where the alpha is to be had. And the way that Swenson would think about it is it's really in those illiquid, inefficient assets where the greatest opportunities come from.
Right. And another way of saying that is public markets tend to be more efficient, information is readily available, and private markets, much more fragmented. There are many corners where there's a lot of inefficiencies where you could theoretically achieve outsized returns for the risk that you're taking that should not exist, but they do because the markets are less efficient.
That's exactly right. And that's exactly David Swenson's position on this. It is that inefficient side of the market where the opportunities are to be found. And maybe just again to throw some data at you, I spent a good portion of my career looking at what Swenson was doing, recognizing it's not necessarily translatable to individual investors, but the Yale endowment through much of his tenure had a 70 to 80% allocation to alternatives. That certainly got the headline. What might not have got the headline because you didn't look under the hood is he typically had a 5% or less allocation to US public equity. What was he saying? Exactly to your point. It's a very efficient part of the market. The real opportunity is where there's inefficiencies, where there's some skill to be had.
Right. And you could also argue that some of that exposure can be found in the private market segment, because if the S&P is up 10%, then the private markets that operate in that same space probably receive the same benefit that allowed the S&P to be up 10%, plus some active management excess return above that.
Yeah, I think based on the data that we look at, and again, we do this analysis on an ongoing basis, we see a 300 to 500 basis point illiquidity premium, excess return that you get for private equity versus public equity. Now, we certainly have periods of time like we did in 23 and 24, where the US public markets actually outperform their long-term historical average. But if you believe in reversion to the mean, which I certainly do, it probably means that there's going to be a period of time that they deliver returns below their long-term historical averages. But over the long run, exactly to your point, you're handsomely rewarded in that form of the illiquidity premium.
Right. And that goes back to the definition of long term. I think in the real world, 1 to 5 years is a long time. In the investment world, it's not a very long time. And that difference, I think, causes a lot of confusion as well. You think of alternatives, the way you've described it so far, as private markets. Would you talk about how you think about that and the way you consider different types of structures within alternatives?
Yeah, so just from a private markets perspective, we actually ascribe different sort of roles with all of the strategies. So I typically think about allocating to private equity because I want to get that incremental return. I want to capture that illiquidity premium over the long run. When I think about private credit, I think private credit as a replacement for fixed income where I can get higher income. Historically, I've also received higher return, but I can also get higher income there as well and some diversification benefits. I think about real estate as being a pretty versatile tool where I can get attractive growth and income in my portfolio. But what's interesting about real estate, both real estate equity and debt, is they both have delivered low to negative correlation to traditional stocks and bonds. So I actually get that built-in diversification, especially when things get difficult. And they're also able to hedge the impact of inflation. So they're an inflation hedge in our client portfolios. And the reason I just frame it broadly like that is then when I start to solve for what am I doing with my client portfolios, I know the role that I'm playing, and maybe I'm going to have a higher private equity allocation to that younger investor who's more focused on growth, and maybe a higher allocation of private credit or private real estate for those investors who wanted more income in their portfolio. So that's kind of the simplistic way that we start our discussion, and then we can do all sorts of modeling to show the impact of adding combinations of those to client portfolios.
What excites you about evergreen structures like interval funds or tender offer funds, private BDCs, and private REITs? And how do these compare with traditional drawdown structures?
It's not one versus the other. It's really the drawdown fund. Again, remember that was only available to 5 million or more in investable assets. They often had high minimums, like a $5 million minimum to get into a private equity fund. So it limited our ability to actually use very broadly. And what evergreen funds have done is has helped us because they're typically available accredited investors or below. They typically have lower minimums, 2,500 to 25,000. They're evergreen in nature, meaning they're on the shelf all the time. So for you, you can actually allocate to all of your clients across the board. When a new client comes in the door, they can get the same allocation. Where, as you know, with a drawdown structure, you're somewhat limited. You have a finite period of time to sell the fund. You need to get your client comfortable and understand what's going on in a finite period of time, or that window closes and they miss out on it. Well, not everyone learns and absorbs information in the same time frame. So I think evergreen is a much more scalable solution across the board. One of the things that we do, again, we don't have a horse in the race. We're just trying to provide education to advisors. Is we've actually looked at the combination of the two, where I think that's kind of an interesting sort of thing. And what I found from a lot of my industry friends and from my podcast series that, family offices and institutions are actually using combinations of drawdown and evergreen. If you think about it intuitively, it makes a lot of sense. If I allocate capital in my drawdown fund, let's say I allocate $1 million today, I realize that that's likely going to be drawn down over a period of time, 3 to 4 years. Where my evergreen fund, I'm actually getting that immediate exposure. So from an asset allocation perspective, that evergreen fund gives me the immediate allocation, which helps me for my client. And maybe I'm going to use the two of those in concert with one another because certain strategies are going to fit better in a drawdown structure. But I recognize it's going to be a period of time because before I'm fully allocated there. So we hear more and more sophisticated advisors, multifamily offices, institutions using both drawdown and evergreen in concert with one another. And I think it makes a lot of sense.
As private markets have expanded over the last decade or two, a new market has essentially emerged, secondaries. Do you think the growing secondary market could eventually allow for trading in private assets similar to public markets?
I don't. First of all, I would say that our highest conviction idea from an investment perspective and a structural perspective is the secondary market. And it kind of makes a lot of sense, right? So for those who maybe aren't completely familiar with secondaries are essentially buying existing positions. And what we've seen over the last several years, a lot of big institutions found themselves over allocated to private equity. So they go to the secondary market. The secondary manager comes in and says, I'll take those positions off your hand, not necessarily paying 100 cents on the dollar. And ultimately, that secondary fund provides diversification. So there's a lot of inherent advantages with the secondary structure. Right? The secondary fund is essentially shortening that J curve and the period of distribution of getting my money back. I'm getting a diversified portfolio. So similar to the way that institutions allocate money, what I'm getting with a secondary fund is I'm actually getting diversification across vintage, geography, GP, and industry. So I'm actually allocating in a much more diversified way, which I think is a better way of getting exposure to private equity. So we'd argue that has become a vital cog in the overall PE ecosystem. It's gone from a relatively small niche industry to a very big part of it. We don't think that genie goes back in the bottle. We also know that big institutions have formal secondary programs where they're constantly selling positions. So we think that part of the market will continue to grow. One example of that, I think it's been fairly well publicized that both Harvard and Yale were actually looking to lighten their private equity exposure. Unlike the public markets where you can say, I want to go to the public markets and I want to sell positions, they can't, right? There isn't a public market available to them. So they actually go to secondary managers, typically the biggest ones who are the only ones who are able to take on those size allocations, and they can negotiate terms and conditions that are appropriate for both sides of the equation. So I think, again, the secondary market looks really, really appealing here. But do they ever become tradable like the public markets? I don't know. And I don't know that I would want to go down that path because, again, what I think makes these underlying investments special is the fact that they're illiquid. And what makes them special is there's some skill involved in assembling them in portfolios. And if we all of a sudden made them daily liquid on a daily basis, I worry that we take away what makes them special. And it's kind of the same argument where I hear from advisors and investors, could we put private credit in an ETF structure? We could, I guess. Do we need to? And do we want to? And again, I'd argue, I think with the evergreen structure, we've got all the basic tenets that we want in there. We also give the manager the freedom to allocate capital to invest for the long run. If we forced it into a liquid structure, whether it's a mutual fund, an ETF, or some sort of daily trading, we probably take away what makes them inherently special in the first place. So I'm not a fan of pushing the envelope too far on that.
I suppose the market could take it to a place where it's more liquid than it is currently, but not as liquid as public markets, because there is a buyer of those secondary interests because they're buying at a discount. And the more buyers there are, the smaller the discount. and you probably settle in a place where it's more liquid than illiquid, but it's not as liquid as daily, and maybe that brings in more investors.
I think we've come a very long way in a relatively short amount of time. It may not seem that way for a lot of folks out there, but I would just be careful that when I allocate capital to private markets, I know it's illiquid. I know that's what makes it special. I know that's how I'm going to capture that long term illiquidity premium. I need to treat that differently. I need to think about it differently. And I don't want to force it into a structure that doesn't make sense. To your point, will we make some modest changes on the margin to make them more liquid, make them more appealing to investors? I suspect we will. I hope we do it with constraints. And I hope we do it keeping in mind that we don't want to take away what makes this a special investment to start with. But I think that's the nature of the industry. We're constantly, challenging ourselves. Can we improve on what's available in the marketplace?
So if you think about these private markets, being a patient long-term investor is a key component. With alternatives now making their way into defined contribution plans based on recent legislation, what trends do you anticipate in terms of democratization and investor education as you open up this massive pool of capital?
Yeah, it's an opportunity that we're very excited about. We think, again, if we take a step back and we recognize that in defined benefit plans, pension plans, they've historically had pretty substantial allocation to private markets. And the reason was they recognize the long term attributes and the benefits that ultimately accrue to underlying investors. The reason it was challenging in the DC world is, partly education, right? Do individual investors really understand the illiquid nature? Do they understand how the strategies work? If we merely put them on a menu, would they make the right decision for the right reason? There were concerns about, did we have the right structure? Because again, mutual funds are daily liquid. It's easy to move money from one fund to the next. Private markets, not so easy to do so. And then, of course, there's the fiduciary sort of issue where plan sponsors were concerned who was taking on that fiduciary responsibility. So, what has been interesting, I think, over the last couple of years, and it's been a very slow process, a very gradual process. I think we have definitely made a lot of progress, and we're starting to see announcements of more private markets in DC plans. I think the natural sort of starting point are in target date funds because they're a little bit more controlled constructs. And I think that's a very good thing for our industry. So we're excited about that opportunity. I'm actually participating on a Kaya webinar on that. And, we're exciting as we're talking about this. I don't think it's all of a sudden the switch turns and everyone does it day one. But I think, again, this gradual process is a prudent way of thinking about it. That clearly is one of the big trends in the industry. I'll throw out another trend, and that is something that I think we're starting to hear a lot more about, is model portfolios. As much as you and I have talked about building and incorporating asset allocation models that include private markets, we understand that that can be challenging for some. So I think there's a growing interest in model portfolios where private markets are part of an overall model, and somebody who maybe that's their area of expertise is making those decisions on advisor and investor behalf. I think that's another trend that we're watching very carefully. But I'd argue that we're still in the relatively early innings of private markets in the wealth channel, and we're going to start to see more products, more granularity of products, more very discrete sort of products over time, potentially more combinations of public and private markets and single structures. So we're definitely in the early innings. There's going to be a lot of growth and innovation, and it's going to be a really exciting time for us over the next 5 to 10 years.
We've talked a little bit about private equity and private credit, but would you share your perspective on the real estate landscape in both public and private markets and how investors should think about the inefficiencies and opportunities?
Yeah, we actually like real estate quite a bit here. I think if we take a step back, the last couple of years have been very challenging for real estate investors. I think with the dramatically rising rates, that was a true headwind for real estate managers. I think with some of the concerns about the office sectors, there were certainly concerns about real estate write-downs. But if I look at the real estate environment today, I think we've definitely seen valuations come down pretty substantially from their peak 2021. A lot of real estate is now available below their replacement cost. We think there are attractive opportunities. We don't necessarily think the office sector looks good, but we think areas like industrial, multifamily housing, look really attractive to us. So I think if you can be smart about allocating capital and you can think about what are the attractive sectors I want to allocate to and what are the problematic sectors that I want to avoid, I think valuations make it a much more attractive discussion here today than it certainly has been over the last 2 to 3 years. Real estate debt is a little bit of an interesting sort of play in the sense that we do believe that there will be some disruption going on in the marketplace. And sometimes it's better to be the lender of choice. And we recognize that historically the banks had been the lender to a lot of those institutions. They're not going to be there going forward. As we look at the data, there's this enormous wall of debt that will need to be refinanced in the real estate sector. We don't believe that banks will be stepping up to fulfill those needs. So we actually believe that private credit managers can choose to be the lender of choice, where they can dictate the terms, the conditions, and the covenants. So to us, real estate, equity, and debt both look very attractive, but for different reasons. And they would be part of our top three ideas. So I mentioned our top three ideas are secondaries, which we like because of some of the disruption and all the capital that's gone into private equity. We like real estate because valuations have come down and we think there are really some interesting opportunities there. And then we like real estate debt, which can play on some of the need for lending in an area where the banks will be reluctant to do so.
What distinctions would you make between private real estate and public real estate or REITs?
Yeah, I don't have a formal view on publicly traded REITs, but I would point out kind of the obvious thing that I think sometimes gets lost in the shuffle, which is publicly traded REITs have a higher correlation to the equity market than they do to the real estate market. When I look at the overall real estate ecosystem, private real estate is 90% of the opportunity set. Publicly traded REITs are 10%. So it's a very small piece of the pie. And they do tend to react much more like the equity market. So if I go back to 2022, when rates were going down, inflation was spiking, what did we experience? Well, publicly traded REITs were down almost equivalent to small cap stocks. And private real estate was actually up. Why? Because they're actually responding to different fundamentals. So I view them very different animals. My focus is primarily on the private market side. So I don't have a formal opinion about publicly traded REITs, other than I think they tend to perform and act much more like small cap stocks than they do private real estate.
With so much capital flowing into private credit, do you see this as a bubble?
Yeah, and it's a question I get a lot. I think when I hear that question, I think it's important to kind of slow down and remind everyone when you say the amount of money going into private credit, you're probably thinking the amount of money that's gone into direct lending, right? Direct lending has been the vertical that has really captured most of the assets. And we'd argue that when you think of private credit, we should actually think about direct lending, asset-based finance, and real estate debt. And we think asset-based finance and real estate debt in particular look very attractive here, partly because it's early in the cycle. We think there's an abundance of opportunities out there for real estate debt in particular. We know there's a wall of debt that will need to be financed. We know the private credit manager is going to have to step in to do so. So we think they're great opportunities. So while there's a lot of money that's gone into direct lending, those opportunities we think afford a lot of opportunities. With respect to direct lending, I think it's also important to characterize that not all direct lending is created equally. Not all managers are going to have challenging times navigating the market. Some will be able to deploy capital. So we'd argue that there are a couple macro themes that we're focused on, which is one is we think there's a difference in deploying capital today. We think, anyone who deployed capital in 2021 valuations, you're paying peak prices for everything. That's whether you're talking about private equity, private credit, or private real estate. And then the other sort of factor that we think is kind of a big macro theme for the next decade is there will be a larger dispersion of return between managers with the experience of navigating good times and bad, and those who maybe are a little newer to the dance and chase the opportunity without necessarily having the discipline along the way. I think being very disciplined and staying true to what got you to the dance in the first place, how did you deliver those long-term results, is very, very important. And Alex, even when we think about traditional investments, it's the same sort of thing. There's always that temptation to take that incremental dollar when sometimes you should say enough is enough. So we think we'll start to see a larger dispersion of return between the really good managers who have the deep and dedicated teams who can navigate through good times and bad, and those who maybe were just a little too eager to take money.
The point that I like to end on and the question for you is related to something you touched on earlier about storytelling. What's your advice for advisors, fund managers, and investors on effectively telling the story of an alternative investment so it resonates, especially as more options surface in the marketplace?
It's such a great point because I think for all of us, it's if you and I were sitting down to have a cocktail or a cup of coffee, you and I would very easily fall into the jargon of J curve and drawdown and evergreen and all of these things that are very comfortable for us. I think we need to bite our tongue a little bit and think before we speak to say, do clients really understand what we're saying? The more we can simplify the jargon, describe it in terms that they understand, provide real examples of what private equity is and how it works, or private credit is just a different sort of structure than fixed income. The more we can make it relatable for investors, the more they're going to be willing to go on this journey with us. The more that we throw jargon at them, we make it more complex and we use terminology that's confusing, the more they're going to be turned off and they're going to say, not for me. So it's a great opportunity, as we've talked about, great products coming to the market. The market environment is demanding a more robust and reliable toolbox. But we need to make sure the clients are having an informed discussion with us so we go on that journey together. So as challenging it is, the more we can simplify it, I think the better it is for all of us in the long run.
Well, Tony, your commitment to investor education and practical portfolio solutions has helped reduce the gap between the sophisticated and everyday investor. Thank you for sharing your journey, your framework, and your views on the future of alternative investing with us.
Thanks so much for having me, Alex.
Thanks for listening. We hope you enjoyed this episode. Please visit our website at insightfulinvestor.org to access past shows and learn more about our podcast. If you have questions, feel free to email us at info@insightfulinvestor.org. And if you enjoyed the discussion, please subscribe to this podcast to ensure you don't miss future episodes. And don't forget to forward today's conversation to others you think would enjoy listening. This podcast is provided for informational purposes only and should not be relied upon as legal, business, investment, or tax advice. All opinions expressed by podcast participants are solely their own opinions and do not necessarily reflect the opinions of Evoke advisors, their affiliates, or companies featured. Due to industry regulations, participants on this podcast are instructed not to make specific trade recommendations, nor reference past or potential profits. And listeners are reminded that securities trading, commodity trading, and alternative investments are complex and carry a risk of substantial losses. As such, they are not suitable for all investors. Listeners should be aware that guests featured on The Insightful Investor may have current or past associations with Evoke advisors or the host, including as an investment manager of a private fund opportunity by Evoke, or access through an affiliated Evoke fund, or as a client. Participation as a guest on the podcast should not be perceived as an endorsement or testimonial with respect to Evoke advisors, the podcast host, or their services. Similarly, the inclusion of a guest on the podcast does not imply that Evoke advisors or the host endorses the guest or any company with which they may be affiliated or employed. Evoke has neither paid nor received compensation from guests for their participation.